Hello trading world, hello YouTube, hello everyone. Today I'm back with something different entirely. Today I'm going to be doing something very different entirely, which is what is Forex for beginners and how to start trading Forex. I know this topic is a very crucial one for beginners, but there are some terminologies that I need you beginner traders to also learn from this video, because it will help you, as it is important for you to know them before diving into Forex trading in practical. Now, I know Forex trading for beginners can be difficult even for some experienced traders, but in general, this is due to unrealistic but common expectations among newcomers to this Forex market. Whether we are talking about Forex trading for beginners or stock trading for beginners, many of the basic principles overlap too. But in this article, we are going to focus on Forex trading and nothing more. Sit back and let's dive into what is Forex in details. Now, on our first slide here, we are going to be looking at what is Forex. What is Forex? Forex, in simple terms, means foreign exchange. The foreign exchange market is the global marketplace for the trading of one nation's currency for another. It is the largest and most liquid financial market in the world, with an average daily trading volume of over $6 trillion, and it is the center for all business and financial market. Government uses the foreign exchange market to implement policies. For example, when conducting business with another country, whether it is borrowing money or even offering money, a country needs to convert its currency into foreign currency. Businesses as well use the foreign exchange market to carry out transactions overseas with their international customers. Forex is an electronic network of banks, brokerages, institutional investors, and individual traders, mostly trading brokerages, or mostly trading through brokerages or banks. Now, let me break it down a bit. If you have ever swapped your local currency for another currency, you have participated in Forex. For example, I swap the Naira for dollar using our local medium here because I want to spend the dollar currency in a region where dollar is being used. And there are rates attached to this exchange. As at the time of recording this video, I think $1 to Naira is 800, which simply means for me to purchase a dollar, I need to pay 800 Naira for $1. I believe you are getting me now. It is the same thing in trading, but quite different because the exchange is done online using our cell phone or laptop computers to analyze the charts and trade alongside with our analysis. And these trades are practically placed on our trading app with the help of a Forex broker, of which we are going to be looking at in the next slide. Like I said, on the next slide, we're going to be looking at some trading applications the Forex trader needs. Number one on our list here is the TradingView application. Number 2 is the MetaTrader 4 and 5. And the third one is a brokerage firm applications. I will break each of them down for you. I will explain their functions for you. TradingView application is a web-based social network for traders that enables traders to interact and share trading ideas, as well as analyze the global market charts and trade directly from their TradingView's advanced charting capabilities. You can download the TradingView application on your cell phone. The TradingView application is on Google Play Store and is also on iOS, which is on Apple Play Store. And it has enough tools available for traders to analyze the charts and trade the financial market. Secondly, for the MT4 and MT5 application, they are just a standalone trading platform that allows you to monitor the market, place trades, and also manage your trades in real time. On the next slide, we'll be talking about the Forex broker. You might want to ask why I didn't talk too much about the TradingView app and MT4 and MT5 application. That is because I want to discuss about the Forex broker. What is a Forex broker? A Forex broker is a financial services company that provides traders access to a platform for buying and selling foreign currencies in the foreign exchange market. E.g., we have the OctaFX, FBS, XNES, and many more of them. Let me expatiate. Before you trade the Forex market, there are firms that actually provides a link for traders to access the global market, and they are known as brokerage firms. These firms are known as brokers. You can download their application on Play Store or Apple Store. You create an account with them and deposit money you want to use to trade live, or you can even demo trade with them. I think at least just for practice, because you cannot just, download an MT4 application or MT5 application and start trading and making money and withdraw like that. No, you have to deposit live money, or you buy a Profirm challenge. That is for people that are experienced. But for the sake of this video, I'm just telling you what a broker does. That is it. On our next slide, we're going to look at something else. Next thing on our slide here is, who are the Forex market participants? The banks, commercial companies, hedge funds, central banks, and individual speculators participate in it and exchange currency on a daily basis for both speculative and hedging purposes. Now, let me highlight the individual speculators, which is for people like me and you. We don't have that big money to trade, but we're also participating in trading using our brokerage firms. We're buying Profirm accounts, to either get bigger capitals to trade the Forex market. So this video, I think so just basically for just simple knowledge. You just want to know who are the participants in the Forex market, and it is just quite simple and short. So that's it. On our next slide here, which is understanding Forex, we are not going to be wasting too much time. We'll just brief on the first paragraph and go to the next slide. The Forex market determines the day-to-day value or the exchange rate for most of the world's currencies. If a traveler, for example, exchanges Naira for Euros at an exchange spot or a bank, the number of Euros will be based on the current Forex rate. And again, if imported Lexus car suddenly cost more at a manufacturing company, it may well mean that the Euros have increased in value against the Nigerian Naira in the foreign exchange market. This one is not too complicated. I think this one is just straightforward. Let's go to the next thing. Key things you need to know about Forex on this new slide. The Forex market is a global marketplace for exchanging national currencies. Secondly, the foreign exchange venues comprise the largest securities market in the world by nominal value, with trillions of dollars exchanging hands each day. Foreign exchange trading uses currency pairs, priced in terms of one versus the other. For example, GBP, USD, USD, Canadian dollar, Aussie dollar, USD. And number 4, which is the last one, forwards and futures are another way to participate in the Forex market. I will explain maybe in another slide. This one is just quite straightforward. These are some key things you need to know about the Forex market. Let's go to the next slide. On this special slide, we are going to be looking at types of Forex transaction. There are 3, but on my list here, I think I made a mistake and I was supposed to put the spot market, the forward market, and the futures market. But I ended up putting the spot market, the forward or the futures market, and then I still added this Forex spot market, which is just a repetition of the same thing on the number 1, which is the spot market. So on our next slide, we will explain what is the spot market, the forward market, and the future market. So let's go to the next slide and briefly explain the spot market before we go to the remaining 2 and move on to other things that are more important. Let's look at the spot market. The spot market is the most straightforward of the Forex market. The spot rate is the current exchange rate. A transaction in the spot market is an agreement to trade one currency for another at the prevailing spot rate. I know this is quite confusing, but for clarity purpose, let me throw more light on it. The spot market is where financial instruments are exchanged for immediate or instant delivery, such as commodities, currencies, and securities. Delivery here means cash exchange for a financial tool, something like that. And again, the spot market are also referred to as liquid market or cashless markets because transactions are instantly and essentially exchanged for commodity, exchanging money for a commodity. That is what I mean here. And let's dive into the Forex forward market very quickly. The Forex forward market, that is the next thing on our list here on the types of Forex transactions. A forward trade is any trade that settles further in the future than a spot transaction. We already know what the spot market is. The forward price is a combination of the spot rate plus or minus forward points that represent the interest rate differential between the two currencies. I know this is also confusing, but let me also explain. Let me throw more light on it. A forward market here is an over-the-counter marketplace that sets the price of a financial instrument or asset for the future delivery. Forward markets are used for trading a range of instruments, but the term here is primarily used with reference to the foreign exchange market. It can also apply to the market for security and interest rates as well as commodities. This might not be too important for this video, but I'm going to still include it. So let's move on to the next thing, which is the futures market. Unlike the rest of the foreign exchange markets, Forex futures are traded on an established exchange. Forex futures are derivatives, contracts in which a buyer and a seller agree to a transaction at a set date and price. I believe this is quite understandable, but for better understanding, I will say this type of transaction is often used by companies that do much of their businesses abroad and therefore want to hedge against a severe hit from currency fluctuations, and it is also subject to speculative trading. I believe you understand what I mean by speculative trading. Yes, you should. This is just, things I just want you to know about the Forex market. So just keep it in mind. Let's move forward to the next thing. The next thing on our slide here is trading in the foreign exchange market. You want to know what trading in the Forex market feels like, the timing and something like that. So let's quickly look at it. The Forex market is open 24 hours a day, 5 days a week around the globe, and thereby divided into sessions, which are the London session, New York session, and the Asian session. This allows traders from all around the world to participate in trading at any time and anywhere. So let me throw more light on it. Now, historically, foreign exchange market participation was for government, large institutions, large companies with plenty money, and hedge funds. But in today's world, trading currencies is as easy as a click of a mouse, and accessibility is not an issue because many investment companies allow individuals to open accounts and trade currencies through their platform. Yes, as you can see today, we have so many prop firms, we have so many brokers. You can easily deposit your $20, $10, $50, $100, depending on the minimum deposit your broker allows, and trade. That is it. That is what trading in the foreign exchange market looks like, and the timing for trading. So on the next slide, we are going to be looking at something else, something good, something you should know. So keep it locked and let's go to the next slide. So on this new slide, we are going to be looking at the assets that are being traded in the Forex market, of which we all know, though not all of us. Since this course here is for beginners, the most widely traded financial instruments on the Forex market are the currencies, commodities, equities, and indices. These are the most widely traded financial instruments on the Forex market. But for the purpose of this video, we're going to be focusing on the Forex pairs, which are the currency pairs. So on the next slide, we're going to look at currency pairs and what is a currency and some other things that you need to know about currency pairs and many more. So on the next slide, let's look into it. Now let's look at currency pairs. Like I say, a currency pair is a price quote of the exchange rate for two different currencies. traded in the forex market, of which one is the base currency and the other the quote currency. Every forex transaction is an exchange of one currency for another, like I said during the introduction of this video in what is forex. A currency pair quote looks like this, just like you can see here, USD, GBP. This is just an example. And in this example, USD, GBP, the base currency here is USD, which is the US dollar, and the quote currency is GBP, which is the quote currency. So let me explain it in details. USD GBP equals 1.15 cents. In this example, the US dollar is the base currency, while the British pound is the quote currency. What do we mean? If a trader wishes to buy British pounds, that trader will pay 1.15 for each. I don't know whether you understand. The US dollar here is the base currency. A trader who wishes to buy pounds, the British pounds, will pay 1.15 cents for each. That is exactly what I mean. I know you might get confused, but I believe in future videos you come to understand this. This is not something too difficult to understand, you know. So let me explain further what I mean by the base currency and the quote currency. Now let me explain further. In the forex market, when an order is placed for a currency, the first listed currency or base currency is bought, and also known as the base currency. It is confusing. Let me say it again. When an order is placed in the foreign exchange market for a currency pair, the first listed currency is the base currency, while the second listed currency in a currency pair is the quote currency. That is the currency that is being sold, and as well called the quote currency. For example, here we have the Euro USD. Looking at the two of them here, the first listed currency here is the Euro, and the second one is the US dollar. What do I mean? The Euro here stands as the base currency, which is being bought. If you are going to sell, you are going to sell the dollar to get the euro. I don't know whether you are getting me. The first listed currency is the base currency. The euro here is the base currency, while the dollar is the quote currency. That is the currency that is being sold. I believe you should understand what I mean by now. This is not difficult. You should understand. Yeah, I know. I trust you. You have a sharp brain. You will understand. Yes, you have a sharp brain, I know. Oh wow, this one here is a big one, which is Forex terms. In other words, Forex terminologies used in trading the Forex market. Sometimes you should know before trading the Forex market. If you're a beginner and you've been in this Forex thing for about 3 months now, I think you should know by now that there are some terminologies that are being used in the Forex market. I believe you're familiar with some of them and you might not be familiar with some. So on this slide here, we're going to be looking at them and explaining them too. There are a number of terms that are already used by forex traders. Here are some of the basics. Like number one, here we have going long, which simply means buying a currency on the belief that its value will increase in a matter of hours, minutes, then it can be sold for profit. And the second one is selling a currency, which is going short. Selling a currency on the belief that its value will decrease. It can then be purchased at a lower price. I don't know whether you're getting me. Of course, I believe you're getting me. You're smart. So the third one here is the ask price. The ask price here is the price the trader will pay to buy a currency pair. And the fourth one, which is the bid price. The bid price is the price the trader will pay to sell a currency pair. Now let's look at spread. Spread is the difference between the buying price and the selling price. Yes, the difference between the buying price and the selling price. And the next one is bull markets and bear markets. Bull markets, these are when prices are rising because of stability. Yes, if you've traded crypto, you know when they see something like bull run, and stuff like that, the market is going up, people are buying and like that, the price keeps increasing. And then bear market, which is the opposite of the bull market, they are associated with dropping price due to instability. Yes, you hear something like market crash and stuff like that. It's not necessarily that market crash, maybe it is due to instability, sometimes due to some things I might not want to mention in this video, like maybe when there is some kind of dispute and I don't know, in the country, and it is affecting the price of things in the forex market, and then you see one particular pair just dropping and stuff like that. And I think the next slide we will explain further on some other terms being used in the forex market. The next on forex terms being used in forex trading is equity. Equity in forex trading simply means the total value of a forex trader's account, the total value of your account. And that is what we mean by equity. You understand? The next thing is margin. You've heard of margin call and stuff like that, account blown and stuff like that. Margin is a portion of a customer's account balance that is set aside in order to trade. Margin is a portion of a customer's account balance that is set aside in order to trade. As simple as that. The next thing here is stop loss, otherwise known as SL. Stop loss is an order that you send to your broker instructing them to limit the losses on a particular open position or trade. When you place a trade, that zone in which you put your SL price or your stop loss price, that okay, if the price comes to this zone, then the trade is invalid. That is what we mean by stop loss. It should be a zone where your whole risk, maybe if you're risking $50 or $20 on a trade, if price gets to that zone, you will lose that $50 or the $20. That is what we mean by SL order. You understand? All these are this one is just an order in the forex market. And the next thing here, we can't just talk about stop loss without talking about take profit as well. Take profit also known as TP. This is a type of pending order that is placed to close a profitable position once the market reaches a specific price. You know, when you place a trade, you set your SL. You also set your target. Maybe you're risking $50 to make $100 or $50 to make $150. So once price gets to a particular zone in which you will make that $150 or the $100, the price, your TP order will be executed, and the trade will automatically, the trade will automatically close, giving you an insight that, okay, yes, you were right on that particular trade. Yes, your TP got hit, and now you're happy, you're smiling. So that is it on TP order. So on the next thing here, we are going to look at another forex term, that beginner traders should know. The next thing here is leverage, which is a big one. I remember that the first time I opened a brokerage account, I didn't even know what was leverage. I just opened and chose 1 to 500, and the next thing I was just using random lot sizes. I made money, I withdrew. The second time I was just over risking my account, I blew it. It was quite sad though. I nearly cried. But let me not waste your time. Let's look at leverage. Leverage is using borrowed capital to multiply returns. The forex market is characterized by high leverages, and traders often use it to boost their positions. This is like a loan. This is like a loan that the broker gives the trader so that the trader has more capital to trade with than what he or she initially deposited. This money is money you cannot see, but your broker knows about it. So some of the leverage levels include 1 to 50, 1 is to 100, 1 is to 200, and 1 is to 500. Here are some leverage levels that is being used in forex. There are still more. 1 is to 1000, 1 is to 2000, but for the purpose of this video, we'll be discussing just these ones. So here is how leverage works. Let's say a trader has a trading capital of $10,000 and trading with 1 is to 100 leverage. According to his leverage, his trading capital is increased 100 times, which means he has a $1 million account size to trade with. It's not as if they are dashing it, it's just something they are using, to borrow you to trade, but not necessarily really borrowing you money. But I just wanted to understand for the purpose of this video. So on the next slide, we'll be looking at lot size. That is what most of us use to blow our accounts. We don't know how to use lot sizing. We don't know the particular lot sizes that are supposed to be used on our account. So let's dive into it and brush up on it. Let's quickly brush up on lot size, because this is what I've used to blow my account. Yes, I've blown so many accounts. I've blown my account, blown accounts, because I was over risking when I started. When I was introduced into forex, I was just opening lot size because I saw one of the big guys in the industry here, Jeffrey Benson, be talking about lot size and stuff like that. So flip your account, all these things, But I was doing it the wrong way though. So let's look at lot size. Lot size in forex trading refers to the volume or quantity of a trade. It represents the number of currency units that are being bought or sold in a particular trade. Lot sizes can vary depending on the broker and the account type, but the most common lot sizes are: 1. We have the standard lot, and the standard lot is the largest lot size in forex trading and represents 100,000 units of the base currency. For example, if you are trading the Euro USD pair, the standard lot would be 100,000 euros. And the second one here is the mini lot. The mini lot is 1/10 the size of the standard lot and represents 10,000 units of the base currency. So, for me not to confuse you, let me throw more light on it for clarity's sake. Lot size simply means the number the trader is willing to stake in a particular trade that equals your risk on a particular trade. The standard lot in Forex equals 100,000 units. It is the standard unit for traders. Yes, we all know that, whether they are independent or institutional. For example, if the Euro USD exchange rate was $1 30 cents, one standard lot of the base currency euro would be 130,000 units. That is what I mean. I believe with this you will understand, because if you don't understand lot sizes, trust me, you're going to blow your account. And if you're using the wrong leverage, these two things will mess you up, especially when you're a beginner trader. If you don't understand lot size and leverage, they'll mess you up. So that is, I think, for the Forex terms, I will just stop at lot size and let's look at something else. Maybe let's look at chart analysis for now and then see what we can do about it and what we can learn. Yo. On this particular phase, we are going to be looking at chart analysis. If you as a trader doesn't know how to analyze the chart, then it will be difficult for you to place trades, because you end up taking wrong things. And even though you're doing chart analysis, I don't know how to read the chart very well, which boils down to how you trade, your strategy and the rest. But in this video, we're not discussing strategy. We just want to know about Forex and how to go about it. So chart analysis is at the base of any trader's strategies and judgments, but there's a lot to learn about chart analysis, as we do have different types of traders that trades what works for them, and these traders may fall under this block of analysts. We have the technical analysts, of which I will say these are the technical traders. We have the fundamental analysts, which are the fundamental traders who likes trading the news, and then the sentimental analysis. The sentimental analysts, these are those who do sentimental analysis, in other words. So we are going to be looking at them in the next slide and know what they do. So the technical analysts are traders like myself who use historical price data on our charts to identify recognizable patterns, which could be in form of trends, repeatable candlesticks pattern, and more so. These patterns are then analyzed to help traders like myself identify the condition of the market, to either know whether we're in a bearish condition of the market or the bullish condition of the market. In other words, bullish market, bearish market, or maybe the ranging market. And on the other side, we have the fundamental analyst. Fundamental analysts are basically for traders that trade news events like economic, social, and political forces that affect currency prices. And thirdly, we have the sentimental analyst. These are for those who use the sentimental analysis to check or measure how other traders feel about the overall currency market or about a particular currency pair before they take their own decision. They want to know how other people feel or think, what other people think about a particular pair before they take their own decision, which is quite sentimental, Yeah, that is how they make their own judgment. So, without doing too much, I'll just say, however, chart analysis is about reading data, like the movement of a currency pair using indicators like support and resistance levels. Although I'm not a support and resistance trader, but I will just say it for the sake of this video. It's just a beginner course. Like support and resistance levels as well as trend lines. But by reading the different levels and using trend lines, you can start to identify areas of significance, and this will help you as a trader to make a judgment on where the market is heading. When you do your chart analysis, you tend to know where the market is headed for, so you can feed this insight into your strategy and decide how you want to trade. So let me just say again, no forex trading for beginners would be complete without discussing charts. So let's go to trading view and look at the chart on one of the currency pairs, maybe Euro USD, GBP USD, or anything. Let's go to the chart and look at one of the currency pairs and identify some of the things we were talking about. So let's dive into it. Like now, this is what the forex market chart looks like. We talked about how to read the market, and we talked about different type of traders that trade news. Some just depend on just technical analysis, like using their trend lines and stuff like that. It's so unfortunate I might not be able to show you how to do some of those things here, but I'll just show you some of the things that you also need to know. Things like candlesticks and things like line charts. If you look at the charts here, we have our chart is blue and black. Yes, our candlesticks are in blue and black. That is what I chose myself because I customize it myself. But if you go and download TradingView application on your phone or PC, you'll be having it in red and green, which is the default setting. So let's say I'm a technical trader and I use support and resistance level or trend line. If I look at this market from this position here, I will discover that the market is coming down, the market is dropping, the market is coming down. In a bearish situation of the market, when the market is coming down, the market will be forming things called the higher lows and the market will be forming things called the lower highs and the lower lows. The lower highs, lower low, lower highs, lower lows, and it will keep breaking structures to the downside. Now this is how we are going to draw our trend line and trade. We'll draw our trend line from the beginning of this move here and then down to this point. How do we trade this? For support and resistance trading, we want to mark out points where the market, you know, is maybe going to come back to after breaking structures using, for this particular one, see, using break and retest level. Now you can see after drawing this point here, the market broke here and then came back after breaking the line, indicating that okay, now we should start selling. I talked about take profit level and stop loss level. Now me as a beginner trader, I will just use my short tool. It's so unfortunate I might not teach all that in this video. My short tool, I will put my stop loss, maybe put my stop loss here, and then I'll look for maybe the next level to target. I'll say okay, there is a support level here, there's a support level here, then I should target this level. Then I'll just trade into the support level here, because I might be afraid that okay, if the market gets to this particular point, the market might reverse on me. So in order for me to protect my positions that are being opened, I will have to target this support level here for take profit. So looking at this thing here, it is just a risk reward of 1:1.27. That is it. So for each time the market comes to touch our trend line, we are going to sell the market. That is what I mean. So if you look at this point again, the market broke that support that it created, and again, what happened? The market came back there. The market came back to retest it. After retesting it, the market sold. You might be wondering, you might want to ask me, are you a support and resistance trader? No, but at the beginning of trading, I was using this particular concept. Every concept works, but I later changed and I started using smart money concepts, which also made sense to me. But if I want to trade at times, I just mix all these confluences and then try to see reasons why I should enter a particular trade. So that is it. So looking at this point here, we can see that the trend came to an end. We draw from here again, we can see that okay, we draw a trend from here. Consider okay, the market didn't want to continue in this channel, and if you draw further support levels, we'll see that okay, maybe the market is using this other support level here to reverse. Now what do? We mark out the support being created here, this high here, this lower high that is being created here. The market broke it, and what happened? The market changed trend and started moving in the upside of the market. Yes. Now we also draw another trend line from here, like that. Let me just make it small. Let me just see this one. After the market broke that high, the market came back, formed a new trend, and then started moving in the bullish direction of the market. So I can also want to shift it like this, because that is what most trend line traders do and stuff like that. Yes, I understand. I'll mark out more resistance area that turn to to support like that. Mark out more of them. Look at another one here. You can see this thing works too. You don't need a perfect strategy. This is just a beginner intro. So let me show you something again that you should know. When you come to your chart on your trading view, As a beginner trader, after learning what we call higher highs and higher lows in the market, when we're talking about higher highs and higher lows in the market, this is what we mean. That should be in a bullish market scenario. You want to see the market like this, doing something like this. You might not see it perfectly on the charts, but doing something like this. Now, look at this is your trend line. This is your trend line. This is your trend line channel. Let me call it your trend line channel. And let me call it your trend channel. Yeah. So, let me duplicate it. Something like this. Each time the market breaks a high, like this, we would label this one. We'll label this high here the higher high. The higher high. Let me just make it easier. Yes, this is your higher high. All those highs there, we'll label them higher highs. Yes. And for the ones below, we'll label them the lower lows. Same thing with all this. With this high here and this one, we'll call them the higher highs. And then for the ones below, we'll call them higher lows. Higher lows. Yes. Let me clone it. We'll call them the higher lows. So for each time you draw a trend line and the market comes to bounce on it, giving you a higher low, touching your trend line, you buy. And in a bearish market scenario, you do the opposite, which is something like this. Let me delete this. I'm just teaching you something I'm not even supposed to teach you on this video, but this is just a beginner course and it is important. Let me just delete it. The market is doing something like this. Lower low, lower high, lower low, lower high, lower low, lower high. Just something like this, just an example. Something like this. We'll label these ones here. We'll label these highs here the lower highs. The lower high. And then this one's here, the lower low. Same thing for this one here, lower low, lower low. So for each time the market comes to bounce on your trend line, if you're mixing it with your support and resistance level, like I showed you there, you sell and do the opposite in the bullish market. It's quite unfortunate I might not be able to show you how to set up your trading view and other things, but for the sake of this video, this is just a beginner chart and a beginner guide to forex trading. So on the next slide, we should be discussing something else, which is how to trade forex or how to start forex trading. So I believe with this little example I've showed you here, you know what I meant by chart analysis and how to read your chart. This is just a live chart, and then let me just show you something again. This is trend line. Me, as an SMC trader, I know, okay, the market created a demand here, and now the market broke the demand. Now this is where I'll be looking at selling the market, because now the market has broke this demand level. So if the market comes back into my zone here, I'll be looking to short the market to maybe this level. Just an example, looking to short the market to this point, and my stop loss like this. So I'll be looking to go for a 1 to almost 4x reward. So that is it. So let's quickly go to the next thing. Yeah, I'm teaching you too much now. Now on this session, we are not going to be wasting too much time. We'll just go straight to the point. Now you might want to ask, can I start forex trading on my phone? And the answer I will tell you is yes. Yes, you can start forex trading on your mobile phone. These days you can trade forex with the mobile forex trading app, that are on Play Store and even Apple Store, depending on the type of phone you're using. These apps do more than allow you to trade while you're on the move. Trading forex is similar to equity trading too. So here are some steps to get yourself started on the forex journey. Let's go to the next slide and list some of them and see how you can go about it. Here on this slide, which is going to be the second to the last slide before we end this beginner course video to what is forex and how to start trading forex. Number 1 on our list is learn about forex. Let me explain why it is not complicated. Forex trading is an undertaking that requires specialized knowledge and a commitment to learning. That means you have to commit yourself to learn. Give yourself at least 2 to 3 hours a day, or even 1 hour a day, to look at your forex chart, to watch videos, to read books. Because trust me, you have to consume a lot of information, read books, and watch a bunch of educational forex videos on YouTube here, online, and then filter the ones that aligns well with you and work with them. Secondly, you set up a brokerage account. From the beginning of this video, I think I talked about brokers and the rest. So you will need a forex trading account at a brokerage to get started with forex trading, because that is what you will need to practice using the demo phase or live trading with real money involved. But it is advisable you demo trade for some time before using real money. So that is my point on it. You have to set up a broker account, a brokerage firm, maybe with OctaFX, XNES, FBS, any of them. While you're still learning, you can demo trade for some time and test out strategies or things that you've been taught about forex trading. You test them out to see if what you're actually learning is actually working. So on the number 3 here, we have develop a trading strategy. Yeah, why it is not always possible to predict and time market movement, you having a trading strategy will help you set up guidelines and a roadmap for trading, and that is what you will have to learn. at least you have to, let me just say, just try to learn 2 to 3 different trading strategies. Work with them for like 3 months, 4 months, 5 months, and then pick one that suits you and then work with it. Make sure you master it, backtest it if possible. Backtest it. Just dedicate at least time to work on your trading strategy, and with time you start getting used to it. So number 4 here is you have to always be on top of your numbers. What do I mean? Once you begin trading, you check your positions at the end of the day. Like for most day traders like me, most trading softwares like our brokers already provides a daily accounting of trades. You understand? So make sure that you do not have any pending positions to be filled, and that you have sufficient cash in your account to make future trades or make further trades the following day or any other day that you want to trade. So number 5 on our list is to cultivate emotional balance. What do I mean? As a beginner forex trader, beginning trying out forex trading is something that comes with emotional roller coasters. Trust me, at times you might want to give up, you even want to cry. Trust me, it comes with emotional roller coasters and unanswered questions. But with discipline, trust me, if you discipline yourself and close out positions when necessary, you tend to start understanding why some certain things are not in line with what you're actually doing. There might be certain times that you are holding down a drawdown trade that you are supposed to close, but because of you have this huge belief that the market will go in your favor and stuff like that, you start getting emotional about the whole thing, and then you begin to doubt yourself and doubt your strategy. So discipline is required in forex trading because it will help your psychology a lot, because psychology is a very big thing in trading. If your psychology is toyed with, trust me, even if you have a good strategy, you find it very difficult to maintain that particular strategy long term, because you will always be doubting yourself and being afraid of taking trades, or when you see a good setup, you might be afraid of taking trades because you're being too emotional about the whole thing. But you have to discipline yourself, set up a trading plan, work with it. If you're going to take 1 trade a day, you take 1 trade. If you're going to take 2 trades a day, just do it. If you want to trade the New York section, you trade the New York section. You want to trade only the London section, you trade only the London section. There's just no way you make $1 trillion in a day or $6 billion in a day. So just do what works for you. Look for something that suits you and work with it. So the last but not the least on our list here is to look for a mentor to guide you. Trust me, this is a big one. Trust me, sometimes all you need is to look for someone that is already experienced in the forex field to cut short your journey. But it could be challenging when you don't have money to pay for the knowledge, which means you still have to learn on your own, of which it might take you a very long time to master the act of trading. But still, I believe having a mentor may shorten the process of learning, of which you learn better and faster. And of course, if you focus and dedicate time to learn, you will learn this thing at least in less than a year plus. Trust me, you will learn this thing and you master a strategy that will make you profitable in the market, after you worked on your psychology and everything. getting a mentor is a very good one. It will help a lot. It will help go a long way. So getting a mentor will help go a long way. So you have to look for somebody that aligns with what you want. Look for somebody that, I want to be like this person. Okay, this person is doing like this. I want to do like this person. So even if you don't want to do like that person, but you like, you kind of resonate with that person's kind of lifestyle and all these things. So you learn from them. So at least they will make your journey faster. So that is it on looking for a mentor to guide you. It's a big one, because in Forex you need money to make money. So if you want to learn, you have to pay somebody to teach you. But if you feel that you can learn on your own, then it is fine. You can do it on your own. Of course, if you believe in yourself, you can do it on your own. All our brains, works in different way, but we all have brain. So some people are fast learners, some people are slow learners. So it depends on you. If you feel you don't have the money, then fine. But if you have the money, I think it will be better for you to go seek knowledge from somebody who is already experienced. So that is it on that. So before I go, let me just talk about some type of traders. This one is a bonus. We have different type of traders. We have the swing trader, we have the scalpers, we have the day traders, and we have position traders. Let me quickly brief on them. Swing traders are those type of traders that likes to hold trades for several days or in a week time, something like that. And then for scalpers hold on to trades for a few seconds to minutes. Their main goal is to grab very small pips in the market as many times as they can throughout the day. And then day traders pick a section at the beginning of the day, acting on their bias, and then ends with either profit or loss, as they do not hold trades overnight. What do I mean? The day trader might pick London section to trade, which is in the morning. If I'm checking our time here, I'm in Nigeria, which is in the morning to trade. If I want to trade the London section, and if I say I want to trade the New York section, that should be by 1:30 or 1 o'clock noon. These are the sessions I can trade based on my time zone. I can't trade in the night. And for position traders, there are those that have trades that stays for several weeks, months, or even years. These traders rely more on fundamentals to make trading decisions. I discussed about fundamentals in chart analysis, so I think you should know that. So that is it. So let me wrap up this course, and then you study it again, listen to it. If there's anywhere you're confused, you listen to it again the second time, then maybe you should get it. Finally, we are on the conclusion part of the video, of which I'm going to wrap up in a few minutes. Knowing all this by reading and watching this video without putting your forex knowledge into practice is surface knowledge. The practical aspect of trading is more important than reading just books, as it will expose you to the charts, as it will expose you to the psychology, the experience, the ups and downs in forex market moves. In order to trade this global market, a broker is needed, as it will link you and enable you to deposit money that in turn will reflect on your MT4 and MT5 accounts for trading live account, or maybe you want to trade a demo account for practice. Some of the examples of these brokers includes OctaFX, XNES, and FBS, and many more. Thank you all for watching, and thank you for giving our time to watch something that we expose you to Forex terminologies and Forex terms. I wish you a good trading life. I wish you good learning. I wish you the best. Peace, and see you on the next one.